Hello, everybody. Welcome to Wednesday. The S&P 500 gave a nice Valentine's Day gift today. Was up 1%. Really nice bounce back. Didn't quite make back everything that we lost yesterday, but almost comically, it closed above 5,000. It was at 5,000.63 points. So just barely, but got there. And, a little bit ways to go to get back to where we were. You're not going to have a market that goes straight up. It just doesn't work that way. You're bound to have lots of pullbacks and fits and starts and such just to kind of get where you want to go. However, this market is displaying, an incredible amount of power and buying that's coming in on a regular basis to kind of drive things. And so I wasn't too worried about yesterday just because, that much power that's out there and that much money that's still on the sidelines is, still going to probably come in and look at the opportunity as dip buying, which is what we seem to see today. And so, that eventually changes and what have you. The market's looking forward, 3 to 18 months. And obviously the market is expecting overall inflation to do well and probably not even expecting a recession in that time frame based on the power of what we're seeing so far. So, we'll see how that works out as far as that goes. But there was a really great quote from one of the Fed governors. I'm going to read that directly here. This comes out of Bloomberg. So Fed Bank of Chicago President Austin Goolsbee said slightly higher inflation data for a few months would still be consistent with the path back to the central bank's goal. He also emphasized it's important not to judge the inflation trend from one month's number and that the Fed's 2% target is based on the personal consumption expenditure price index, not CPI. He noted that the two metrics can differ somewhat significantly. So this is what I was saying yesterday. CPI is something, honestly, I don't spend a lot of time really worrying about one way or another because the Fed's not that worried about it. They do look at it. I'm sure it makes a difference. But when they talk about 2%, they're talking about PCE, personal consumption expenditure price index. And if you look at PCE and you look at core PCE, take the last 2 months, it's already, the last 6 months and you annualize that out, we're already at 2%. If you take the last 3 months and annualize that out, we're actually at 1.5%. And that's the numbers they're looking at, and that's what they're trying to gauge, what they're going to do as far as that goes. And honestly, I think this economy is pretty strong. There's a lot of things going on. Job growth is great. We're seeing, great consumer spending and what have you. And the stock market is certainly, a leading indicator. It's showing, that it's believing that the stock market, that the economy can continue to do well. And I think this market can handle these higher rates. I don't know that the market, the economy needs that, lowering of rates to be stable or what have you. If anything, I wouldn't be surprised. I'm not saying it's going to happen, but I wouldn't be surprised if we don't see a rate cut this year. I know the market's expecting a bunch, and even the Fed is expecting, to do 3 rate cuts this year. And that could be very likely happen. But the strength that we're seeing right now kind of makes me think it's definitely going to be later on in the year. No doubt about that. And the market is starting to accept that also. So anyway, that's what's happening right now. Really good day today. Hopefully we'll regain what the rest of what we lost yesterday tomorrow or soon thereafter. Anyway, look forward to talking to you then. Thank you.